Good day. My name is Claire St. Pierre. I'm a certified general accountant. I'll be spending the next few minutes or so with you, working with you on an introduction to accounting, which has been provided to you by the Certified General Accountants Association of Ontario. Let's start. Introduction to accounting. What is it? This brief accounting preparedness course is a non-credit course which has been designed to help graduating high school students who might not have taken accounting during high school to prepare for their first accounting course at post-secondary school. This pre-course contains the essence of the accounting cycle and some terminology that students will learn during their first part of their post-secondary school accounting studies. Course description. This course introduces students to accounting terminology, some basic accounting principles, functions within a business, and the complete accounting cycle. Students will learn how to record business transactions, prepare and analyze financial statements. Our learning objectives today are looking at the different types of accounts we have, reviewing some accounting principles, learning about the rules of debit and credit, the applications thereof. We're going to look at the accounting cycle. We'll be recording some business events, preparing financial statements, and also preparing the closing process. So what different types of accounts will we be working with? Well, there are 5 different types of accounts. We have assets, liabilities, equity, income, and expenses. Assets is the group of things that you would own, items that may be convertible into cash. For example, you have cash, car, home, stock, bond. Liabilities. Liabilities is the group of things on which you owe money. In other words, debt. Could be a car loan, student loan, or a mortgage. Equity. Equity is the same as your net worth. It represents what is left over after you subtract your liabilities from your assets. It could be thought of as the portion of your assets that you own outright without any debt. The formula for this would be assets minus our liabilities is equal to our equity or a net worth. Income. Income would be the payment that you receive for your time, the services you provide, or the use of your money. You might have a paycheck, commissions, tips, interest, and dividends. Expenses. Expenses refer to the money that you would spend to purchase goods or services provided by someone else. For example, it might be a rent, groceries, a car payment, or perhaps a phone bill. Now let's look at the golden rules of accounting. We've looked at the different types of accounts we have, and now let's look at what kinds of accounts these would be. We have 3 different types of accounts: personal, real, and nominal. Now a good accounting system is to find the information about a transaction in a single entry. By looking into the nature of an element, the elements affected by the transaction, we may decide on what to debit and what to credit. Any account that is affected by a transaction either has to be debited or credited. To do this, we have a set of rules we use to apply the debit and the credits. The accounts are widely classified into these 3 categories as you see: personal, real, and nominal. So let's look at how debits and credits might act on these accounts. For personal accounts are accounts that are related to a person or an organization. The accounting rule that is used for this type of account is debit the receiver, credit the giver, or debit the benefit of the receiver, credit the benefit giver. Real accounts. Real accounts relate to accounts that are tangible and intangible, such as assets, reserves, capital, and liability, and whose balances are carried over into the next operating cycle. These are often called permanent accounts. The accounting rule for this would be debit what comes in and credit what goes out. Next, we have nominal accounts. Nominal accounts are also called temporary accounts, which would be closed out at the end of each period by moving their balances to our permanent accounts or our real accounts. Accounts that come under this type are expenses, gains, revenues, and losses. The offsetting entry to these accounts often might be to assets or liabilities at the end of the period. The accounting rule that's used for this type of account is debit all expenses and losses and credit all income and profits or gains. Further rules of debits and credits come back to something called the double entry accounting. The double entry accounting means that every transaction will affect the two accounts, the receiving side and the giving side. The rules of debit and credit are that the debit entry is made on the left-hand side and the credit entry is made on the right-hand side. The second rule of debit and credit is that the total debits must equal the total credit, which also means that you must balance every transaction. Now, some of the applications of these entries would be, if we had assets, as you see in purple, assets, to increase our assets, we would debit the asset account. We would make a left-handed entry. So therefore, we can consider that assets have a normal balance of a debit balance. If we wanted to reduce our assets, we would prepare a right-handed entry and credit the assets to reduce it. With liabilities, if you remember, liabilities are our debt. If you want to increase your liabilities, you would make a right-handed entry or credit your liabilities account. Liabilities accounts have a normal balance of credit. If we want to reduce our outstanding liabilities, we make a left entry to our liabilities. With shareholders' equity, the normal balance for shareholders' equity would be on the right-hand side or a credit balance. If we wanted to reduce our shareholders' equity, we would prepare a debit entry to shareholders' equity, thereby reducing it. As you can see below, we also have expenses and revenues. Now, expenses have a normal balance of a debit, left-handed side entry. That with any entry made on the left-hand side would increase our expenses. Any entry made to the right-hand side or any credit entry would reduce our expenses. When it comes to revenues, revenues have a natural credit balance. The normal balance is to see something posted on the right-hand side. If we wish to reduce our revenues, we would debit the account. Now, up top, where you see assets, liabilities, and shareholders' equity, this is our accounting formula. Our assets are equal to our liabilities plus shareholders' equity. Those are the two components that would make up our assets, which would mean that our net assets are equal to our assets minus our liabilities if we reverse the formula. Also, please note that when we close out our temporary accounts would be expenses and revenues. When we close out our expense account, we would credit our expense accounts to reduce the amount to zero, and we would debit shareholders' equity. A debit entry to shareholders' equity would reduce the shareholders' equity and bring down that account balance. So by posting and clearing our expenses to shareholders' equity, we reduce shareholders' equity. When it comes to revenues, revenues have a natural credit balance. In order to reduce our revenues down to zero, we would clear out our revenues by making a debit entry. And the offsetting entry would be on the credit side to shareholders' equity, thereby increasing shareholders' equity. So in summary, we have for assets and expenses, a debit balance is our normal balance. A credit balance would reduce it. So you could think of ADE, assets, debit, expenses. Also, when it comes to our credits, liabilities and revenues have a normal credit balance. So one might think LCR, liabilities, credit, revenues. Now we're going to work through a few exercises over the next few moments in preparation of a comprehensive question which takes us through all of the accounting cycle. So at any time you might want to stop and review what we've done. So you can start and stop the webcast at any time. We've also broken out the webcast into 3 components. The introduction, part 1 and part 2 of the comprehensive question, and the balance of the comprehensive question is in the last part. And this is to allow you some time to absorb and review what we've done at every step. So just now we're going to look at a very brief exercise using something called T accounts. And we saw the T accounts and the effect on our account with our debit and credit entries. So let's do a real little exercise running through some postings to our T accounts. So, for example, we've got item number 1. You can see under prepaid insurance a debit entry for $1,200, and under accounts payable we also have item number 1, $1,200. So what's that all about? You've received an invoice for business insurance, and you receive it on January 1st. The invoice covers the period from January 1st of the current year to December 31st of the following year. In other words, this insurance coverage covers a full 2 years. So we would recognize that we have an asset or are acquiring an asset of prepaid insurance, and we would increase our asset by debiting prepaid insurance by $1,200. We also must recognize that we have a liability that has arisen on the receipt of this invoice, and we will credit accounts payable for $1,200, thereby increasing our accounts payable balance by $1,200. So our second step, we're required to pay for the insurance in advance, so we would record a prepayment of insurance in the prepaid insurance account. The prepayment of insurance is an asset and therefore debited, prepaid. Assuming we're not paying cash, we've posted this to accounts payable. At the end of the month for step 2, we pay the invoice in full for the business insurance. To clear the payable, we would debit the accounts payable to reduce the account by $1,200, and since it took cash to settle the accounts payable, we would credit cash by $1,200, thereby reducing our cash account by $1,200. Now at the end of the year, we must record that 1 full year of business insurance has expired or has been used up. We would therefore debit our insurance expense account for 1/2 of the insurance and credit the prepaid insurance for the same amount, $600. So at the end of the year, we would still have a balance of $600 in prepaid insurance. So we'd have an asset of $600. We would also have a balance in our insurance expense, a debit amount of $600. Let's look at another exercise. In exercise 2, we have a customer who makes a deposit in step 1 for some upcoming work. We receive the cash and debit the cash account. So we're debiting cash, increasing our cash asset by $1,500, a left-handed entry. The $1,500 that we've received has not been earned and therefore represents a liability that we must fulfill in the future, so we credit the liability count unearned revenue. This is a prepayment for services, and it has not as yet been earned. We will have to provide some services in the future. Subsequently, the customer receives 2/3 of the work. We've extinguished 2/3 of our liability, and in step 2, we would debit unearned revenue by $1,000 and credit sales to recognize the work completed. Now for step 3, another customer is billed for work completed in the amount of $2,000. We have yet to be paid for the work, so we would debit accounts receivable for $2,000, and we would also credit sales in step 3 for $2,000. So our accounts receivable account is an asset account, and it would increase by $2,000. Our sales is a revenue account, and we would credit that to increase that account by the $2,000. When the funds arrive for the $2,000 account receivable, we would, in step 4, debit cash and recognize the increase in our cash balance by $2,000. And we have to reduce our accounts receivable and credit that account by the $2,000 to clear that balance. Now let's do another small exercise, exercise 3. A little bit more complicated than the 2 first exercises. Again, working with our T account, we buy a piece of equipment and we purchase that piece of equipment on account. The equipment is an asset and it costs $60,000. So under equipment, we would debit equipment, which is an asset account, so we'd increase the balance by $60,000. We also have to record the liability at the same time, and we would record a credit in step 1 to accounts payable, recognizing that liability that must be settled in the future. You've agreed to pay 5% per month over the next 4 months. We make a payment of $15,000 at the end of the first month. So we would record a debit of $15,000 or a reduction in our liability account, and we'd also record the decrease in cash by crediting the cash account for $15,000. Now the terms of repayment are 1% per month after the first month. So it's going to cost us a little bit for not having settled the account in full when we purchase the equipment. So at the end of the following month, we receive an invoice for $450 in interest charges. Now this is an expense, so we would record the payable by crediting accounts payable by $450, and to recognize the expense, we would debit our interest expense account by $450. Also at the end of the second month, we pay the second payment, and we also include in that payment the payment for the interest charges. We would make a debit to accounts payable for $15,450 to reduce that liability for the 1/4 of our $60,000 plus the payment for the interest expense, and we will credit cash to record the cash payment in the cash account. Another concept we can look at is amortization, often called depreciation. At the end of the year, we need to record and recognize an amortization expense that relates to the using up of the equipment. We estimate that the equipment will have a useful life of 10 years. To record the using up or consumption of the equipment, we record a amortization expense of $6,000, which represents 1/10 of the useful life of the equipment. The offsetting credit entry is made to an account called accumulated amortization, which is a contra account to the equipment account. When we sum up the equipment, which has a debit balance of $60,000, and the accumulated amortization equipment account, which has a credit balance of $6,000, we see that the equipment has a net book value of $54,000 at the end of the year. So we're going to be looking at some of the things that we do with these amounts that we've posted to our T account. What do we do with these debits and credits? Well, in step 1, we acquired the equipment, and in step 2, we've made a payment on it. Step 3, we recognize an interest expense. Step 4, we recognize a payment for the accounts payable. And in step 5, we recognize accumulated amortization. So what can we do with these numbers? Let's see what we can do with our $60,000 in equipment and the posting of the $15,000 to accounts payable. So we would carry over the $60,000 entry and the $15,000 entry to our journal. In a journal, we have an area in which we set up the date for each transaction. We also have an area where we set up the account and provide the account title. We also have the debits and credits that we will carry over from the account. So to record the acquisition of this equipment under account, we would recognize equipment and accounts payable. The equipment would be debited for $60,000 and accounts payable credited for $60,000. We would also make a note so that we would know what the journal entry was all about. So we would note that this is to record the purchase of equipment on account payable over 4 months with 1% interest per month. Now, we also said that we were going to take a look at what happened with the $15,000 payment, the first payment that we made on the account. In order to reduce our accounts payable, we reduced it by $15,000. We debited the account. A liability account is reduced, as we said, with a debit entry. We're also going to credit cash and reduce that account at the same time. And once again, we provide a small notation so that we remember what this journal entry is all about, and we write to record the first payment for the $60,000 equipment purchase. Now let's also take a look at what we can do with these key accounts when it comes to something called a trial balance. And we're going to be looking a lot more at the trial balance and journalizing and financial statements in a few minutes. So we're just going to take a small tour of the trial balance. All of the amounts that we have posted to our T account can be summarized. We would add up the debit side and we'd add up the credit side, and you'd either have a total balance, some total balance on either debit or credit side. Then you would take those amounts and post them to something called a trial balance. So in this case, we're going to be looking at the account balances we have for equipment, for accumulated amortization, for accounts payable, amortization expense, and interest expense. We'll leave out the cash balance at the moment since we don't have our opening entries. So these amounts will be summarized, and under our equipment, we had a total value of $60,000. Under our accumulated amortization equipment, we had a total amount of $6,000. We had a posting of sum up of $60,000 less $15,000 plus $450 less $15,450 gives a total sum of $30,000 for accounts payable, which is on the credit balance side. For amortization expense, we had a total of $6,000 and interest expense of $450. So you can see that we carry over the balances from our T account to this document called the trial balance, and we're just posting the amount. Now, what do we do with the trial balance? The trial balance is used to create financial statements. So we do our journalizing, we're posting to our T account, we're summarizing the balances in our T account, we're carrying over those amounts to our trial balance, and once we have our trial balance, we create our financial statement. So let's take a quick look at where these amounts would go. Our asset accounts, our revenue accounts, and our expense accounts, and our liability accounts. So let's have a look at, firstly, our balance sheet. On your balance sheet is broken up into 3 sections: assets, liabilities, and owner's equity. And we have made some postings to cash, equipment, and accounts payable. So as I said earlier, we're not going to carry over our cash balance, but that would fall under the category of assets, and it would be current assets. We also have the equipment, which is a long-term asset, and we carry over the title, equipment, and the account balance of $60,000 to our balance sheet. And as we said earlier, that amount in accumulated amortization actually reduces the carrying value or the net book value of our equipment by the $60,000. So we would sum those two up, and we see that equipment has a net value of $54,000. Under liabilities, we had our accounts payable balance, or closing balance, at $30,000. So our balance sheet would start off with the title of the company at the top of the page. You would write balance sheet. And since the balance sheet is a snapshot of the organization at a particular point in time, you would write as at, and then the month, the day, and the year. So just a little snapshot of what is carried over from our trial balance to the balance sheet. Now, what about something called an income statement? Our income statement is not a snapshot at a particular point in time. It covers the business activities over a period of time. And the amounts that we've carried over from our trial balance relate to expenses. We didn't recognize any income in our third exercise, so there's nothing to record there. But the income statement will start with income, and it will reduce that total amount in income by the expenses in order to determine what the net income is for that particular period. So in our trial balance, we had an amortization expense balance of $6,000 and an interest expense of $450, and those amounts are carried over to our income statement, showing the activities during that period. Once again, our income statement would start with the title of the company at the very top of the page. We would write income statement, and since this covers a period of time, we would write for the period ended month, day, and year. So just some small things to keep in mind when it comes to our trial balance, our T account, our journalizing, and where all this information goes to and where it flows to. It flows out to our financial statement and results. And that brings us to the accounting cycle. And we've just gone through a few steps in the accounting cycle. So in the accounting cycle, we would be looking at business transactions. We would identify the business transaction, and we would generate or obtain a source document. Next, we would look at the documentation and analyze the transaction. We would determine the transaction amount, which accounts should be affected, in which direction, that is, do we debit the account, do we credit the account, asset, liability, revenue, expense, shareholders' equity. After analyzing, we would journalize the transaction, and we've just done a little example of journalizing. We record the transaction in the general journal by debiting and crediting the appropriate amount. We would also be posting these journal entries into our T account as we've worked through. The T account balances are carried over to something called a trial balance. As we saw, trial balance is what we use for producing our financial statements. So the journal entries are posted, and the postings to the T account summarize that information. Those summary account balances are transferred to our trial balance. After we look at our trial balance and analyze it a bit, we must determine whether it needs further adjustments. And if it does require further adjustments, we will prepare the journal entry. We will post them and create our new balances to carry over to something called an adjusted trial balance. So we have a trial balance which starts out being unadjusted, and if there's further adjustments to make, we call it an adjusted trial balance. Once we're satisfied with the balances on our trial balance, we will create our financial statements. And as we just saw, our financial statements are generated and prepared by using this trial balance. Closing entries are then made to the temporary accounts and posted to those accounts. And when they're posted, we generate a post-closing trial balance to ensure that all of the accounts have been properly closed. Once they've been properly closed, the cycle starts all over again with looking at our business transactions, preparing or generating source documents, analyzing, journalizing, posting. etc. So we're going to be walking through a comprehensive problem, and this is a problem that encompasses all of the accounting cycles. You've been given a link to the problem. You've been given a prepared set of T accounts that you can use and prepare your entries and postings as we work through the problem. You've also been given a blank trial balance worksheet to work with, and you can see that it has several sections. It has an unadjusted trial balance, an adjusted trial balance, and a post-closing trial balance. So T accounts are trial balances. You've also been given some blank pages to prepare your financial statements, and a few other blank pages are available to you to prepare and journalize the entries that we'll be journalizing. So at this particular point in time, you might want to take a break and get everything printed out and have it all ready for the next leg of the presentation. And in this presentation, we're going to be working through analyzing, recording, preparing trial balances, preparing adjusted trial balance, financial statements, closing entries, and on post-closing trial balance. So right now, you should get all of the material ready. And once that's done, click on the second link for the comprehensive problem, and we can get started.